So let's talk about the market, because something really strange is happening. On one hand, we're seeing the stock market absolutely soar, hitting brand new, never before seen record highs. But on the other hand, if you take the temperature on Wall Street, people are terrified. It's this wild paradox, right? Record highs and extreme fear all at once. So what is going on here? Let's get into it. Okay, before we jump in, just a quick heads up. Everything we're about to cover is for news and educational purposes. So this is absolutely not financial advice. All the numbers, all the quotes, they're pulled straight from the sources we're looking at today. All right, let's start with the good news. Check out this number, 6921.75. That right there is the S&P 500's all-time high, which it hit back in October 2025. I mean, no matter how you slice it, that is a sign of a seriously powerful market. But that's not the whole story. Not even close. Because while stocks were hitting that peak, something else was bubbling up just beneath the surface. And that something is how investors are feeling, their sentiment. If you look at CNN's Fear and Greed Index, which is basically a mood ring for Wall Street, the needle is pointing straight to extreme fear. Seriously, it's the most scared the market has been since April. So what gives? To figure this out, we've got to dig into the data. First up, let's look at the big picture, the economy's overall report card. And let me tell you, it is full of some very mixed signals. So on the one hand, things look great. I mean, the Atlanta Fed's GDP Now model is predicting a really strong 4.2% growth for Q3 of 2025. That is a fantastic number for the economy. And that brings us to this really big question. If the economy is cooking with gas like that, why on earth did the Federal Reserve just cut interest rates? It makes no sense, right? It feels totally backward. Well, it turns out the Fed is stuck between a rock and a hard place. They're trying to do two things at once. Their first job, fight inflation. And core inflation is still sitting at 2.9%, which is way higher than their 2% goal. But their other job is to make sure as many people as possible have jobs. And, well, hiring has started to look a little weak. So this tug-of-war is making a lot of investors really, really nervous. So, how's the market taking all this? Well, for now, it's actually looking on the bright side. Here's a great quote from Bill Merzit at U.S. Bank Asset Management. He says that investors think the Fed is cutting rates based on old news, on past data, not because they're worried about the future. And that belief, that optimism, is a big reason stocks are still so high. Okay, let's shift gears to the other elephant in the room. You just can't talk about the market today without talking about the AI frenzy. It is the biggest thing driving these record highs. But the million-dollar question is this a genuine boom, or are we just living in an AI bubble? And man, the excitement is just undeniable. You have Jensen Huang, the CEO of NVIDIA, saying sales for their new AI platform are off the charts. And when he talks, everybody listens. That kind of talk has sent AI stocks into the stratosphere. But you know how it goes. Every time you see a rocket ship like this, you have to ask, has the hype just gotten way out of control? Is this whole thing a bubble just waiting to pop? And what's super interesting here is that it's not just your average investor getting nervous. A recent Bank of America survey asked professional fund managers, the pros who do this for a living, and more than half of them now think AI is a bubble. And look, they're not just talking, they are voting with their wallets. We're seeing some of the heaviest hitters in the investment world back away. Peter Thiel's fund, they sold all of their NVIDIA stock. SoftBank, they cashed out too. And get this, Michael Burry, the guy from The Big Short, is now actively betting against NVIDIA. When you see the so-called smart money heading for the exits, that is a huge red flag. So all this talk of fear and greed brings us to our next point. What's going on inside investors' heads? The psychology of the market. Forget the spreadsheets for a second. What are people actually doing? Well, it turns out they are borrowing money like there's no tomorrow. And to get this, we need to talk about something called margin debt. So what is it? It's pretty simple, actually. It's when investors borrow money from their broker to buy even more stocks. Think of it like pouring gasoline on a fire. If you're right, your profits explode. But if you're wrong, your losses get magnified, and it can wipe you out. And right now, the amount of margin debt in the U.S. has hit a mind-blowing $1.13 trillion. That is the highest it has ever been, ever in U.S. history. It means investors are taking on more risk than at any point we've ever seen. So why should we care about this giant pile of debt? Well, history has a pretty clear and pretty scary answer. You look back at the last few times we saw margin debt spike like this. In 2000, right before the dot-com crash. In 2007, right before the financial crisis. And in 2021, just before the big sell-off in 2022. Every single time, a huge crash followed. And that puts a giant flashing question mark right over today. Okay, so we've got all these signals pulling in opposite directions, right? A strong economy, but a nervous Fed. A massive AI boom that might be a bubble. And record-breaking debt. So what happens next? What are investors looking for as we close out the year? Well, a lot of people are crossing their fingers for what's called a Santa Claus rally. It's this funny thing that tends to happen historically, where stocks get a nice boost in the last couple weeks of December and the start of January. It's a seasonal trend that could give this market one final push. And what might kick that off? You guessed it, the Fed. Right now, the market is betting there's a 72% chance the Fed cuts rates again in December. Another cut like that could be just the fuel needed to light up that year-end rally. So how in the world do you navigate a market this confusing? Again, we're not giving out advice here, but the experts tend to come back to a few timeless ideas. Make sure your portfolio is diversified. Keep some cash on the side. Really focus on the quality of the companies you own. And maybe the most important one right now, cut back on your own personal debt. And really, that brings us to the main takeaway here. When you're in a market that's just full of conflicting signals, the biggest risk you face isn't picking the wrong side of the trade, it's letting your emotions choose for you. In an environment like this one, having a disciplined strategy is more important than ever.